Till now, you have learned the importance of saving, understood what is the amount you should be saving on a regular basis depending on your personal circumstances, and also learned how you can put a system in place so that those savings are channelized towards your investments on a periodic basis. You also learned about how credit cards can help you organize your spends and make the most of your spending habits. From there, the next question is, you've put aside that much money to be invested on a regular basis. Where should you invest the money? In this session, we will introduce the various asset classes available for you to invest, because each time you invest, you are buying a day that you need not work. An asset class is a category of financial instruments that share similar characteristics. All asset classes can be grouped under financial assets and physical assets. Physical assets pertain to those assets which you can touch and feel, whereas financial assets are those which are held in a dematerialized form. Let's look at some of the asset classes that you must be familiar with. Some of the financial assets that you would be familiar with include cash, debt products, and equity products, while some of the physical assets that you may be familiar with include gold and real estate. To give you a broad overview, as per Karvy Private Wealth's India Wealth Report 2019, in the financial year 2019, Indians invested close to 61% of their wealth in financial assets, while the balance 39% was invested in physical assets. This is an increase from the previous year where 57% of the wealth was invested in financial assets and 43% in physical assets. To put things in perspective, on an average, 80% of the wealth in developed countries is invested in financial assets rather than physical assets. So you see, there is a preference for investing in financial assets than physical assets in the developed countries. Let's understand a little bit further about the 5 asset classes and also introduce you the various products you may be familiar with when making an investment decision. Cash is basically held in the form of either hard currency notes or in the form of money held in your savings bank account, money held in your online wallets which make it convenient for you to spend, or money held in a certain category of mutual funds which are known as overnight funds or liquid funds. Cash is a low risk, low return product. What we mean by low risk, low return, we will learn in detail in the subsequent part of the session. When you think of debt products, some of the products which you would have invested in include public provident fund, employees provident fund, fixed deposits or recurring deposits with your bank or with the post office, bonds and debentures issued by corporates or issued by RBI. Debt products as an asset class is associated with a low to medium risk category and a low to medium return depending on your choice of the issuer of the debt class. From here we move to equity. You can invest in equity by buying shares, by buying a portfolio management scheme, or investing in equities through the mutual fund or the ETF route. Equities as an asset class is associated with high risks and high returns. On the physical asset side, first we have is gold. Gold as an asset class is again associated with medium risk and medium returns. The way you can buy gold is in the form of jewelry, which is most popular in a country like India, or you can buy it in the form of gold coins. To put things in perspective, India invests close to 700 tons of gold every year. The other ways to buy gold include buying sovereign gold bonds, buying a gold mutual fund or a gold ETF. The last asset class is real estate, wherein you can either decide to buy land in the form of agricultural land or a plot of land. You can buy a residential property, you can buy a commercial property, or today you can also invest in a real estate investment trust. If you look at the physical assets categories, the traditional ways to invest in gold and real estate has always been through the physical route, that is buying jewelry or buying land or a property. There are ways to invest in this through the financial route or through the non-physical route. A gold bond or a gold mutual fund, you own gold but you don't get actual physical possession of the gold. Through an REIT, you own real estate properties but you're not physically owning that property. So the differentiation between a financial and a physical asset are blurring over time, wherein there are non-physical ways to own a physical asset. Now that you've seen the 5 asset classes, the next question is, should I be buying all the 5 asset classes, or which asset class is right for me? That is what we will try to answer through the entire duration of this course and help you decide what asset class is good for you. You can compare this process to making a smoothie. When you make a smoothie, you have an option to a number of ingredients, but you pick those which will result in a flavor that you like and that you prefer for regular consumption. You will not make a smoothie using all the ingredients, because then what will be left with just a glass with a lot of mess in it, right? In the same way, when you look at the various asset classes, you need to pick those asset classes that are right for you and that will help you in your journey to wealth creation and achieving your goals. So the question is, how should I choose which asset class is good for me? Before I answer that, you need to understand two important characteristics that are associated with each of these asset classes. And these two are returns and risk. Let's take up each of them one after another. The first one is returns. Return is what you get for parting with your money today. You are ready to let go of an option to consume the money today and give it out so that somebody else can use it and give it back to you after a certain period of time, and that is what you are being remunerated for in the form of returns. Let us look at what should be your return expectations from the various asset classes. Cash is generally associated with a return of approximately 3.5% in India, which is what you earn for the money that is lying in your savings account. Debt as an asset class is associated with returns of about 8 to 9% when you invest in any of the debt products available to you. Equity as an asset class has given an average return of 16% in the last 40 years, but the actual returns that you earn can vary quite a bit. The range can be pretty wide, and that is why equity is the high risk, high return asset category. More on this when we talk about equities. Though gold is known to be pretty volatile in terms of the returns, with some of the years giving fantastic returns, with something as near as in the year 2020, the kind of returns you've made in gold. But on an average, gold has given a return of about 9% in the last 30 to 40 years. So though it has become a pretty volatile asset class of late, in the long run, it has given an average return of about 9%. And the last asset class is real estate. Now, this is the most difficult asset class to define because there is no average return that you can make on a real estate investment. It is extremely location specific. So the returns you make in a real estate investment in Bombay is going to be very different from the returns in Chennai, which is going to be extremely different from the returns that you make in a tier 2 or a tier 3 city or a town, or the agricultural land that you buy in a rural area, which is pretty far from any kind of development that you can think of. So although we have shown you a very wide range for real estate, it is the actual returns that you make is going to be very location specific. Now that you understand the return expectation of the various asset classes, let's move to understanding the risk associated with these products. Before that, what exactly is risk? Put in simple terms, risk is nothing but variability in return. If you invest in a product which there is going to be a large variability in returns like equity, that means the risk of investing in equity is high. Whereas if you invest in a product where the expected variability in return is very low, that means such product has a low risk associated with investing in them. An example being a typical fixed deposit. Along with the returns associated with the various asset classes, there is a commensurate risk associated with each of them. Does that mean that you should not take any risk at all? Before I answer that, let me show you a couple of videos to give you an idea of what risk is.
मल्हार से याद आया, मैंने मेरी मल्हार की प्रॉपर्टी बेच दी है। पैसे कहाँ इन्वेस्ट करूं?
म्यूचुअल फंड्स में और कहाँ?
पर मैंने सुना उसमें रिस्क है।
ये फैन तेरे ऊपर गिर गया तो, बिजली तेरे ऊपर गिर गई तो, यार इतना रिस्क तो लाइफ में भी है और म्यूचुअल फंड्स में भी बनता है।
फिर तो सही है।
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
वरुण, हेलमेट।
Thank you, sir.
Hi, I'm Varun Patel's mom.
Yes, I know.
I hope Varun can face the fast bowler.
Mrs. Patel is prepared.
I know, but fast bowler, what if he gets injured? It's quite risky.
बॉलर फास्ट हो या स्लो, रिस्क तो है।
आउट होने का या बॉल लगने का, दोनों।
I know, पर वरुण,
आप म्यूचुअल फंड में इन्वेस्ट करते हो?
of course, since 2005, पर वरुण,
इवन म्यूचुअल फंड्स आर सब्जेक्ट टू मार्केट रिस्क, वहां भी तो नुकसान होने का रिस्क होता है। व्हाट अबाउट दैट?
सचिन, म्यूचुअल फंड्स में उन्हीं को इन्वेस्ट करना चाहिए जो रिस्क लेने के लिए तैयार हो।
मिसेस पटेल, आई एम सेइंग द सेम थिंग। म्यूचुअल फंड हो या क्रिकेट, वन शुड बी रेडी टू टेक द रिस्क।
Good point.
म्यूचुअल फंड निवेश बाजार जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।
What you see from this is that there is a risk associated with everything that you do in life, whether it is the choice of the college that you study, whether it is the choice of the employer you decide to work for, or choosing your life partner. Everything that we do in life is associated with a certain amount of risk in anticipation of some returns. And that's exactly what happens with your investments. You have different asset classes with different return expectations and the associated risk with each of these investments. To help you understand in simple terms, what are some of the basic risks that will be associated with investing in these products? The first one is a variability in return. That means if you invest in an asset class and you expect to earn 8% returns from that particular product, but at the end of the year you realize that you've earned only 6%, that is the risk associated with investing in that asset class, right? Which is variability in returns, not getting the returns that you expected when you decided to invest in that asset class. The second risk that you must be aware of is the loss of principal. Here, you don't even get back the principal amount that you invested in. So if you put aside ₹1,00,000 in a fixed deposit and at the end of the year, for some reason the bank goes bankrupt and you do not receive the money back, then you've lost your principal amount. So neither did you earn the 8% you expected when you invested in the product, but you're not even getting back your principal amount for investing in the product. And another risk that is the most underrated one, but you must be aware of, is liquidity risk. That is, you not being able to sell the product when you need the money. So if you invest in a particular asset class and you're not able to liquidate it, convert into cash so that you can use the cash for the purpose for which you got into the investment in the first place, that is again a huge risk that you face when you invest in any of the asset classes. There are a number of other risks associated with investing. It can be inflation risk, market risk, default risk. We will talk about all of them when we talk about the various asset classes in detail in the subsequent sessions in our module. If I put the 5 asset classes on a single pyramid and rate them in terms of the risks and return associated with them, this is how it will look like. The base of the pyramid is cash, which is low risk, low return, and then we have debt, gold, real estate, and right on top is equity, which has a high return and a high risk associated with it. And with this pyramid comes the most fundamental principle in investing that you will ever learn, and the principle is high risk, high returns, low risk, low returns. What I mean by this is, if you are investing in an asset class, you can expect high returns only if there is a high risk associated with that product. Whereas if you are investing in an asset class which has a low risk, you cannot expect high returns. You will only get low returns from such an investment product. If you are able to understand this principle well, you will know exactly when you are investing in any of the 5 asset classes as to what am I investing in, what are the characteristics associated. Is it a high risk, high return product, or is it a low risk, low return product? So when you invest in a product with a high return, it is going to be associated with high risk. So what is important is to learn how you can manage the risk. That is what is extremely important. You have a lot of tools, you have a lot of options available to you which will help you understand the ways in which you can manage the risk, and that is what we are going to teach you in the course of this session. First, help you understand the risks associated with products, help you understand the return expectation that you should have when you invest in the product. So when you have a product which has a high risk associated with it, is it that you should not invest in the product? And if you do not invest in the product, then how can you expect high returns? So what we are going to teach you through this entire course is, what is your return expectation for investing in various products? What is the risk associated with that particular returns? And most importantly, how you can go about managing the risk associated with investing in various asset classes. Once you understand the risk associated with investing in the different asset classes, then earning high returns will not be something meant only for the elite class. But this is a principle which should stay with you, and you must go back to when you make every investment choice, which is high risk, high returns, low risk, low returns. Any product that violates this principle should ring the bells in your head as to how is it possible. If you remember the famous Hindi movie Hera Fairy, in which a scheme is launched out for various investors, wherein it promises to double the money of the investors in 21 days. If you remember the dialogue, 21 din mein paisa double. What eventually happened was the investors who were the main lead roles of the movie lost all the money, and they spent their entire time only trying to figure out how they can recover the money which they lost. What was the problem with that particular scheme? That scheme promised high returns against a low risk, which again is just not possible in the real world. Talking about the real world, it is just not in the movies. Even some of the high profile investors have lost their money. To give you an example, if you heard of the Vikram investment company fraud, which happened in the year 2018, which duped its investors of close to 300 crores of rupees by promising high returns against the low risk associated with those investments. Some of the high profile names who lost money in the scheme include Rahul Dravid, Saina Nehwal and Prakash Padukone. Along with them, thousands of investors put their money in this scheme in anticipation of 40% returns and eventually never saw their money again. Whenever you make an investment decision, keep this principle in mind: high risk, high returns, low risk, low returns, and any product which offers you a return which is not in commensurate with the risk associated with the product, that should ring bells for you, and you should check whether it is a viable product for investment or not. In this session, we've introduced the 5 asset classes for you. That was cash, debt, equity, gold and real estate. And we will discuss each of these 5 asset classes in detail in the next 5 sessions, so that you understand the various products through which you can invest in these asset classes, the risks associated with these products, and the returns that you must expect when you invest in these products. We will discuss each of these in detail so that you are aware of the various products available. And then when we move to module 3 of the course, that is when we will talk about how you can take an investment decision when talking about these 5 asset classes. To sum up things for you in this session, understand that all the 5 asset classes come with a very different risk and return profile associated with them. While returns are the rewards you get for parting with your money today, there is a risk associated with each asset class, which is nothing but the variability in the expected returns when you invest in the asset class. Always remember the prime principle of high risk, high returns, low risk, low returns, and let that guide you in every decision that you make when making an investment. In the next session, we will start with the first asset class that we talked about, which is cash.